Welcome to the Fed Life Podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
And welcome to part 2 of TSP Modernization Topics with the guru, Ed Zerndorfer. We are here on the Fed Life Podcast. Welcome. I'm Dan Sipe. I'm your host for this, also branch manager here at Serving Those Who Serve and Lee Sipe & Associates. And once again, if you have been living under a rock for the last 20 years and have not read anything by Ed Zerndorfer about federal benefits, consider this your introduction. Ed is a certified financial planner, a chartered federal employee benefits consultant, a chartered financial consultant, a certified federal employee or federal benefits specialist, an enrolled agent with the Iras. He is a member of the Maryland Society of Accountants, National Association of Enrolled Agents, International Society of Certified Employee Benefit Specialists, Financial Planning Association, the National Association of Life Underwriters, and the Society of Financial Service Professionals. And he has been writing extensively and teaching extensively about federal benefits for 20 years. So welcome back, Ed.
Thank you, Dan. It's a pleasure being back.
And it's great to have you. So once again, as I always do in this situation, because Ed will tell you what's going on, I need to let you know that the opinions of Ed Zerndorfer are not necessarily the opinions of Raymond James or Serving Those Who Serve. And the podcast is presented for information only and should not be taken as advice. All listeners should consult their personal advisors before taking any action, although Ed really does say good stuff. So we're coming back, and let's pick up where we left off with this primer as we promise to dive into the enhancements as a result of the TSP Modernization Act. And we're going to do a little bit of a recap of some of the things we covered in the last episode relative to Roth TSP and traditional TSP. We're also going to touch on the scary term abandonment. And we're going to talk a little bit about the mechanics of this change. So what's going to be happening leading up to that date of September 15th, 2019, which if you caught the last episode, we give a hand to Congress, OPM, and the Retirement Thrift Investment Board. They're actually coming in 2 months ahead of schedule.
That's correct.
So attaboys to be given there. All right, Ed, so let's go ahead and jump in and talk a little bit about the Roth side of things.
Yes. Back in 2012, the TSP started offering the Roth Tsp Option to go side by side with the traditional TSP option. So employees ever since 2012 have had the opportunity to contribute to the both accounts, actually, traditional and Roth. Of course, there are limitations as far as how much they can contribute. But one of the most often asked questions I get during seminars from employees is, Ed, I realize that there's this Roth TSP option. I've been told my income is too high. I'm not allowed to contribute to it. Well, I said we have to. Let's talk about this. We have to understand there's another Roth out there called a Roth IRA that is separate from the Roth TSP.
Very true.
During 2019, anybody who has earned income, or maybe somebody's retired but has a spouse who continues to work, would be allowed to contribute to a Roth IRA as much as $7,000. They're over 50, 6,000 if they're under 50, into what's called a Roth IRA. The restriction on Roth IRAs is strictly income. There are income limitations as far as who can contribute to a Roth IRA. Without getting into too much detail here, those people who are married finally jointly in 2019, if their a total income is over $203,000, neither spouse can contribute to a Roth IRA. If somebody is single or files as head of household and their adjusted gross income is over 100, I believe it's 138,000, that individual would not be allowed to contribute to a Roth IRA. This is not the case with the Roth TSP. The Roth TSP has no income restrictions. So this opens the door for federal employees who have this, I call problem. They can't contribute to a Roth IRA because they have too much income, but they would be able to contribute to the Roth TSP with no restrictions. The only limitation, again, is during 2019, federal employees can contribute a maximum $19,000. This is called the regular contributions, IRS's elective deferral, $19,000 to the traditional and to the Roth in combination. And if they're over 50, they can contribute an extra $6,000 in catch-up contribution, a total, so they could contribute both to the traditional TSP and the Roth TSP if they're making catch-up contribution, but their total contributions of both cannot exceed $6,000.
Boy, I love that you took the time to do that, because I remember when the Fed brought in the Roth TSP, and we would meet with the people we serve and bring it up. And really, on a number of instances, I'd say a good 40 to 50% of them would say, yeah, I can't do that. I make too much. So I love that you took the time to do that. And folks, that is an important thing for everybody to know about this. So we have folks that can go into Roth TSP. And on the withdrawal side, to recap some of the things we touched on in the last one, the current situation would not necessarily be as attractive as what it will be after the 15th of September, correct?
The current situation on withdrawal, and it's interesting that there are individuals who started contributing to the Roth TSP in 2012, 2013, 2014, and many of these people are retiring now, and they asked me, well, can I take money out of the Roth TSP and not have to pay tax on anything? Let's just back up here and understand how contributions are made to the Roth TSP and how they're made to the traditional TSP. With the traditional TSP, an employee contributes to the traditional TSP with salary that has not been taxed. A portion of their gross salary is being contributed to the traditional TSP. The account gets earnings, dividends, capital gains, interest, whatever they're getting in their account. No taxes being paid until the money is withdrawn.
Gotcha.
And the money can be withdrawn penalty free if an employee retires sometime during or after the year they're 55 years old. 55 years old.
Gotcha.
With the Roth TSP, contributions are made with after-tax dollars. There's no tax savings up front when somebody contributes to the Roth TSP. The employee has access to the same TSP funds as they have with their traditional TSP, namely the C, S, I, F, and G funds. There's the L funds. The account gets earnings, dividends, capital gains, interest, same thing as the traditional account, but here's the big difference. When money is withdrawn from the Roth TSP account in a so-called qualified distribution,
mm-hmm.
the retiree will not pay tax on anything. We know that the contributions were already taxed. They would not be taxed again. But it's the earnings that are not going to be taxed. All those earnings that have been growing all those years, so-called tax deferred, will not, in fact, be taxed when they're withdrawn, provided it is a qualified distribution. So the question is, what is a qualified distribution?
What is a qualified distribution?
When it comes to a Roth.
Okay.
A qualified Roth TSP distribution, in order to make a qualified Roth TSP distribution, an individual has to fulfill two requirements. One, the individual has to be at least age 59 and a half.
Okay.
Two, it has to be at least 5 years from the year that the person made his or her very first Roth TSP contribution. The very first one actually goes back to January 1st of that year. So, in fact, if an employee retires, let's say this year on December 31st, 2019, use an example,
mm-hmm.
and that employee made his or her first Roth TSP contribution, let's say back in 2013, that's more than 5 years ago, then that employee, that's now retired employee, can start withdrawing money from the Roth TSP and not have to pay tax on anything because it has been 5 years. Assuming the employee is at least 59 and a half, there's no tax on the earnings.
Gotcha. And am I correct that under the current rules, if somebody has retired and they are going to take money from TSP and they have both traditional and Roth balances, that they can't decide not to take from Roth? They're going to have to take some from both.
That is correct, Dan. And here's the problem. Let's say somebody is over 59 and a half.
Gotcha.
They retired before, let's say they retired last December 31st, 2018. They were 60 years old. They're over 59 and a half. They have both a Roth account and they have a traditional account. And they decide they want to start making monthly withdrawals from their TSP account.
Mm-hmm.
Under current rules that they're under, the retiree cannot tell the TSP, only take it out of my traditional TSP account and leave my Roth account alone. It's going to come out pro rata.
Gotcha.
If this employee, let's say, made his or her first Roth TSP contribution, let's say in 2016, it has not been 5 years since they made their very first Roth TSP contribution, which means, the money's going to come out of the Roth account, but the retiree is going to have to pay tax on the earnings portion of the Roth account.
Ouch.
Here, that defeats the whole purpose.
Sure.
Again, until September 15th, the retiree has no choice of specifying only coming out of the traditional account. So let's say September 15th. Let's say take an employee retires December 31st, 2019.
Right.
Made his or her first Roth TSP contribution back in 2016. They can tell the TSP, I want monthly withdrawals, but leave my Roth TSP account alone. I'm going to wait until 2021 when I fulfill the 5-year rule to start taking money out of the Roth TSP account. This way, they won't have to pay tax on the earnings at that time.
Well, that sounds like a pretty good advantage.
So it's a big advantage because
Sure.
a lot of employees got the shock. They thought that all along it's going to be tax-free when they take the money out. They're over 59 and a half.
Well, as we know so often, as it were, the devil can be in the details.
So it always comes down to, like I say, Dan, all the time, before you do anything, please talk to your tax advisor and financial advisor before you do anything drastic.
Yep. We couldn't agree with you more, Ed. One sort of sidebar question here, because I know from the way we approach things and how we view how you might use tools differently. One thing that is unchanged, am I correct about this, is that the allocations would be the same for both traditional and Roth. So at this point, they can't say, I'd like my Roth to be allocated this way, meaning the mix of C, S, I, G, or the L funds versus the traditional. That
is correct, Dan. There's no change in that. However you contribute to the traditional account will be allocated the same way in the Roth account. You can't specify differently. Got it.
But nevertheless, being able to differentiate between traditional and Roth, that's another one that I think we have to give a hand to Congress and the TSP board for coming up with that. Now, this is actually kind of a segue question because, and I'm really lobbing a softball to Ed here because I'm about to bring up a term called required minimum distribution, which is near and dear to accountants everywhere. But because there is a rule called required minimum distribution that affects both traditional and Roth, as well as our next enhancement, why don't you just take a minute or two and sort of run through required minimum distribution rules so people know what we're talking about, because our next conversation about abandonment kind of ties in with that. So why don't you take a moment and bring everybody up to speed on RMD?
Sure. There's a rule, and this is an Internal Revenue Code rule, IRS rule, that when an individual turns 70 and a half, they have to start withdrawing from their traditional IRA and qualified retirement accounts. Now, when I say qualified retirement accounts, I'm including 401k plans, 403b plans, the TSP, traditional TSP, and Roth TSP. The Roth TSP is subject to required minimum distributions.
Gotcha.
There's only one type of retirement account that is not subject to required minimum distribution. That is a Roth IRA. I'll get back to that in a few moments.
Okay.
But what happens is when an individual has a qualified retirement account, each year they have to take out what's called a minimum amount from that account. And if they don't, the IRS has a penalty waiting for them. How much is the penalty? 50%. That's 50 of the shortfall.
Ouch.
If a person was supposed to take out, let's say, $5,000, and they did not take it out, IRS will impose a $2,500 penalty for not taking that money out. And that, by the way, that 50% penalty is each year the person doesn't take the money out.
Ouch.
It's compounded. So how does the one calculate his or her RMD? It's very simple. Every year the qualified retirement plan will do this, or a traditional IRA custodian will do this if the owner requests it. The year, whatever age they are, on the preceding December 31st of a particular year, the custodian or the retirement account, whoever's running the account, the administrator,
Sure.
will look at the account balance as of December 31st of the year in question and divide it by the individual's life expectancy. And the IRS has a table of life expectancies. When one is 70 and a half, the life expectancy is 27.4 years. And the way that comes up, the way the 27.4 is, the IRS is assuming that the individual has a beneficiary who's within 10 years of their
And you got me all excited. I thought the IRS was going to tell me I was going to make it to 97 if I got it to 70 and a half.
That's right.
Oh, they're factoring my wife in. Okay, got it.
Gotcha. Now, if you happen to be married to Dan, to someone who's more than 10 years younger than you, there's a different table that's used.
Okay.
Where it's actually a much smaller number. It could be like 45.
Got it.
So marrying younger women does help, Dan.
I'm going to forget you said that, Ed, because I'm sure you would agree. You married the perfect woman, as did I. So
Yes.
We're just going to move on from that.
No complaints. So again, this is done every year. Now, as I mentioned, there is a 50% penalty for not taking out the RMD in a particular year. But I'm going to just mention something here that it is my prediction that anyone who has a TSP account will never be subject to a 50% penalty from the IRS once they turn 70 and a half. And the reason I'm going to say that is because every January, the TSP will send a TSP account owner who's over 70 a notice what they have to take out in RMD for that year.
Okay, that's great.
If the person loses that letter and ignores it, doesn't do anything, no problem, because to come the following December, something is going to show up in their bank account. It's called an RMD. IRS does this automatically. Dan, I don't know of any traditional IRA custodian, any brokerage, any qualified retirement plan. I can't think of any that does this. Just the TSP.
So that's what they did to deal with the scary term abandonment issue. Because prior to, it was a situation where if they reached out to you, you didn't respond, they considered the account abandoned. Now, you could recover it, but you had to go through processes to do it.
That's correct. And that was mainly for employees who left the government, did not retire. They mainly left the government, and they forgot that they had TSP accounts. And when they turned 70, there was a rule that said, there is a rule, because it's going to change, that if you don't take out your entire account, then the TSP will consider it to be abandoned.
Yeah. So that's a good fix. Now, I do want to do one last little wraparound on the required minimum distribution part.
Yes.
Once we get to RMDs, are we still able to differentiate between Roth and traditional if they're both in there, or we're going to have to take out a Roth too?
As I mentioned, the traditional TSP has an RMD, and the Roth TSP has an RMD. They're separate. But I have a planning strategy that I recommend to individuals who have the Roth TSP in order to avoid having to take the RMD. And that's the following. If an individual has a Roth IRA,
Gotcha.
one of the options, what you can do with the Roth TSP, is to transfer it directly to an existing Roth IRA.
Okay.
If one does that before the year they turn 70, this way, when they turn 70, they will not have to worry about RMD from the Roth TSP.
Well, that's a great tip.
Why is that? Because the Roth IRA, everything is under the Roth IRA now, and the Roth IRA is not subject to RMD.
That's a huge tip right there, Ed. Let's talk a little bit about sort of the countdown to this and in the transition period. Is there anything we need to know about what's going to be happening in September? Any special dates that we need to be aware of beyond the 15th?
Actually, you have to back up to September 6th.
September 6th.
Okay. If someone let's say they retire, I know somebody's going to retire on August 31st. Good day to retire this year.
Okay.
And they want to start they're planning for this to start taking money out of their TSP. Well, any requests that they're going to go to the TSP for withdrawals have to be completed by September 6th, because nothing's going to happen between September 6th and September 15th as far as the TSP.
So there's a quiet period.
There's going to be a quiet period.
Okay.
Quiet period. So those people who are going to be retiring this summer, July, August, need to think about what they want to do with their TSP account and make their decisions before September 6th, because between September 6th and September 15th, it's going to be a shutdown period as far as TSP is concerned.
Okay, so folks, remember, once they start looking at closing those pools, you need to be making some decisions. So Labor Day is going to be a bigger deal this year. Wow, Ed, it still amazes me. I don't know how you managed to stay on top of all this, but on behalf of Feds everywhere, I thank you for doing this. That's a wrap for this episode. And Ed, once again, thank you for coming in to help people prepare for these enhancements. Don't forget, folks, you can always read Ed's latest work in the Fed Zone at stwserve.com. You always have the opportunity every single month to learn from Ed live at complimentary open enrollment workshops conveniently located throughout the DMV. For more information on those, please go to www.stwserve.com and click Seminars and Events. Ed Live is not to be missed, especially when somebody asks him a question that gets him a little bit spun up. It is awesome. You can also find seminar links for us on Facebook. Be sure to check us out on Twitter and LinkedIn. So for the amazing Ed Zerndorfer, the crew of Serving Those Who Serve, and me, Dan Sipe, thank you for listening. Please share this with friends and strangers. Remember to subscribe to the YouTube channel so you always know we're adding content, because, Ed, you're going to come back, aren't you?
Absolutely.
We're going to make you a regular,
Thank you.
And we will keep adding content. And, folks, please, please, please remember, it's your Fed life. Make it a great one, because you deserve it. We're out.
Thank you for listening to the Fed Life Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Neither Raymond James Financial Services nor any Raymond James financial advisor renders advice on tax issues. These matters should be discussed with the appropriate professional. Investing involves risk, and you may incur a profit or loss regardless of strategy selected, including diversification and asset allocation.
Raymond James is not affiliated and does not endorse the opinions or services of any of the quoted professionals or their respective firms. Any opinions are those of Dan Sipe and not necessarily those of RJFS or Raymond James. This case study is for illustrative purposes only. Individual cases will vary.